Hello everybody, welcome to Monday Market Must Knows. My name is Merlin Rothfeld and it is a busy week for things that you need to pay attention to. We'll focus on about 3 or 4 of them for this episode. Let's start things off with your earnings calendar. Now it is the tail end of earnings season, not a lot of really exciting stuff going on, but there is one name in particular. Let's start things off with Monday, which is Casey's General Store. Tuesday has Dick's Sporting Goods. Wednesday brings you AMC and Campbell's Soup. We've got 2 contenders here. Grab a bowl of Campbell's Soup and watch that Reddit pump and dump stock AMC report earnings and see how exciting that one will be. Thursday brings you Oracle, the big name for the week, DocuSign and Ulta. And then Friday brings you Jinko Solar and The Buckle. Now, as you can see, it's tapering off. 2 weeks ago, we had over 1,000 companies reporting earnings. Last week was over 500. This week, 476 to be precise. Now, let's move on to the big stuff, the market changers, the game-changing events going forward. That's talking about bonds and interest rates will be our discussion. When we look at bond auctions, there are 2 auctions coming up this week for the 10-year and the 30-year. Now, we've talked over the past couple episodes of Monday Market Must Knows on about bonds and interest rates. Here's why it's so important. The bond yields have been rising significantly because the Treasury Department has to sell more 10-year and 30-year bonds to service all of the interest payments on our debt. As they do that, supply floods the market, and demand, if it stayed the same, yields would still be going up. Now we're seeing demand dropping significantly and people shorting the bond market because it's such a predictable action that prices are going to drop. That means we could see yields spike unless the Fed does what we expect them to do, which is step in and start buying those bonds. Now, the auction times, if you want to know when they are, Wednesday at 1:01 p.m. Eastern Standard Time. That's right, 1:01 p.m. Don't be late. 30-year is going to be on Thursday, so we've got 2 consecutive days, Wednesday and Thursday, of these bond auctions. This could create tremendous moves in the equity markets. Why the equities? It's bonds. Well, it has to deal with another number called Consumer Price Index and an ugly I word, the most foul I letter you can use in the markets, inflation. Now, inflation numbers are measured in a variety of different ways. There's CPI, there's PPI, and of course the overall inflation number. We're going to focus on CPI, which is Consumer Price Index. That number comes out Wednesday at 8:30 in the morning Eastern Standard Time. Consumer Price Index is the value of a basket of goods and services put together by the Bureau of Labor Statistics. And it's a measurement of inflation. Are those prices rising? Are you and I paying more for goods and services, or are we paying less? Now, of course, we can split up that list and find out areas within CPI that are showing spikes in prices or dropping quickly. Bottom line is this. Jerome Powell came out last week saying, hey, I'm expecting inflation to rise here going forward. If that's the case and interest rates rise as they are, we could see some systemic problems. Why? Well, if we see inflation, one of the tools the Fed likes to use to help control inflation is to control interest rates, the short end of the yield curve. So let's look at 2 charts here. First one's going to be actual CPI. You can see anything above 0 means we are seeing month-over-month increases in the price of that basket of goods and services. If we look at this little red box here, this is what's happened since COVID. You see February, March, April of last year, we're actually showing contractions in CPI, but we've been above that 0 line ever since, but nothing that's really out of the ordinary. So keep your eye on that announcement this week. If we get above 0.5, that could signal higher inflation. Now we have higher inflation, let's take a look at the yield curve. Here's that yield curve we looked at last week, which shows you the different maturities from treasuries and bonds ranging from 1 month to 30-year. 1 month being on the left-hand side, 30-year being on the right-hand side. And of course, you're going to be rewarded by keeping your money in a bond longer term. That's why you see their yield on the 30-year is about 2.25, and the yield for a 1 month is almost 0. Now, what will happen is if we do start to see inflation rise and that number spikes on CPI, the Fed's going to try to modify this yield curve and raise that short end to help fight it. Just bumping it up is going to have a significant impact on the equity markets. Now, of course, this isn't something that's going to happen instantly. This will be something that takes some time to build, but it looks like the wheels are set in motion for a rise in inflation, bond yields to rise, Fed stepping in to try to control the long end of the yield curve, but having to raise that short end. This is something we'll have to pay attention to for our markets going forward, and we'll keep your eye on it on Monday Market Must Knows. We'll see you next week.